The last learning objective is to describe ethical business issues related to accounting. President Theodore Roosevelt said, "To educate a person in mind and not in morals is to educate a menace to society." Roosevelt knew unethical behavior does not work. Sooner or later it comes back to haunt you. Moreover, ethical behavior wins out in the long run because it is the right thing to do. Ethics in business is really a system of values analyzing right from wrong. Most companies have a code of ethics to encourage employees to behave ethically. But codes of ethics are not enough by themselves. Owners and managers must set a high ethical tone, as we saw in the earlier section in this chapter on control environment. The owner or CEO must make it clear the company will not tolerate unethical conduct. Accountants are expected to maintain higher standards than society in general. Their ability to do business depends entirely on their reputation. Most independent accountants are members of the American Institute of Certified Public Accountants and must abide by the AICPA Code of Professional Conduct. Chapter 7 Summary. Internal control systems are the rules and boundaries that help protect what the company owns, ensure that the company is operating efficiently within those rules, and ensure that the accounting reports accurately show transactions that have occurred. The Sarbanes-Oxley Act changed the rules for auditors, limiting what services they can perform in addition to the audit and requiring the evaluation of internal controls. SOX also created the PCAOB to watch over the work of public companies' auditors. Internal control procedures include hiring competent, reliable, and ethical personnel, assigning responsibility for various tasks so accountability may occur, separating key duties so that one person doesn't have access, recording and authorizing functions, performing internal and external audits, and pre-numbering documents sequentially. The key to each of these controls is that the cost of the control should not exceed the benefit or the savings from implementing the control. Internal control for e-commerce changes constantly as technology continues to advance and new threats to online security appear. Protecting the company's computer systems and, therefore, the company's electronic assets from these threats is a top priority when designing a company's internal control system. Bank account controls help safeguard the most liquid of company asset, which is cash. These controls include signature cards, deposit tickets, checks, bank statements, EFTs, and bank reconciliations. The bank statement, whether online or in paper form, identifies transactions that need to be recorded in the cash account. The reconciliation is a control over cash. Internal controls are designed to ensure that all cash received gets to the company's bank as quickly and securely as possible, and that all cash payments are made in a timely manner to pay the actual bills of the company. Because petty cash is so liquid, the main control over petty cash is establishing one individual who has control and responsibility for the petty cash fund. Internal controls should be designated to remove the opportunity for individuals to act unethically.